we find ourselves in uncertain times, and I think uncertain times are the single best environment in which the discipline of investing equips us. And when I talk about the discipline of investing, I think there are two attributes that stand front and center. And the first attribute is that effective investing, intelligent investing, is about buying good companies. And the second key attribute of intelligent investing with effective results is buying those good companies at the right price. Now, in turbulent or difficult times, it's almost ironic that investors tend to shy away from markets, whereas what is being tested is the quality and strength of companies. So that's being demonstrated by businesses almost on a day-to-day basis. But the second element, more than anything, is being offered up, and that is prices are becoming increasingly attractive. So I think more than anything, turbulent times are the very best time to be looking for investment opportunity. And if we scan the domestic market at the moment, I think there are a number of really compelling stories that jump off the page. Whilst there are some broad clusters that I think are very interesting, resources, for instance, strike us as a broad investable idea right now. There are some companies that stand out. And one company in particular that has caught our attention over the last 2 years is a business called Conduit Capital. And Conduit Capital captures our attention for the very first time because the business is essentially under-researched and unknown. And where you find under-researched and unknown companies, you immediately have a great prospect of finding something that is inefficiently priced, by which I mean it's incorrectly priced. And with time, correct pricing comes about, and you are rewarded as an investor for not only going into under-researched parts of the market, but for your thoroughness and your patience. So what has struck us about Conduit Capital is, I think, one of the first elements that immediately appealing is it's an easy to understand business. And Conduit Capital starts its life as an owner of a broker called Constantia Insurance, an insurance brokerage firm. And I don't think insurance brokerage it may be a very competitive industry, but it's one in which the earnings are delivered or they're not delivered. Clients arrive or they don't arrive. And so you have an identifiable business. And that business can't be masked by earnings massaging. It has to be delivered in the form of cash flow also. Over the last few years, Conduit has evolved from being essentially a brokerage business to starting to write their own insurance contracts, and that will immediately point to greater profitability prospects where you are writing your own insurance as opposed to insuring elsewhere. And they've also started to build an investment portfolio that sits behind that insurance business, what we call in the insurance industry a float of your investable capital. Maybe it's worth pausing there just for a moment, because if we talk about the size of Conduit Capital, I described it as an under-researched and unknown business. By Johannesburg Stock Exchange standards, this is a very small company. Its market cap is 230 million rand. It was substantially smaller. It was about half that size. But today, at 90 cents a share, that equates to 230 million rand. And here's an immediate reason, I think, to look at it very carefully. They have 250 million rand cash on the balance sheet. They have no long-term debt, apart from the contracts that they write, of course, but their balance sheet debt it doesn't need to be taken away from that cash figure because the balance sheet is unencumbered in terms of long-term liabilities, apart from some moderate contractual obligations like leases and so on. The net asset value is 102 cents to be exact versus the share price of 90. And if anything, our analysis says that net asset value is understated, because apart from the brokerage business and the insurance that they're writing, they have another element to the company, which is an investment in a debt recovery firm called Anthony Richards and Associates. That is a extremely well-run, very profitable business. It's carried on the balance sheet. The figures are available to investors, but our assessment is that the carry on the balance sheet is substantially lower than what that company is worth in the market at the moment. And if we attribute fair value to Conduit's investment in Anthony Richards, I would say you could comfortably add another 30 cents to the net asset value. And I think that that's a conservative figure. So with some very unsophisticated analysis, you can arrive at a fair value for this business of at least around 30 versus the current share price of 90 cents. The business is profitable, which I think is a key attribute of a quality company. It's been profitable for many years, every year in its current incarnation. And the return on equity is attractive, which means it's profitable relative to the size of your investment in the company. They declared a dividend in the last financial year, which worked out at 10 cents a share. At the time that they declared the dividend, you could invest in the share at about 65 cents. So you got a 10-cent dividend on a 65-cent share, which is a very attractive dividend yield. If you work backwards and say, well, if I bought the share today at 90 cents, I'd still get the same 10-cent dividend, that still works out at a trailing dividend yield of 11%. But I suspect that might be misleading, because I'm not convinced that Conduit will declare another dividend this year. They are retaining cash to reinvest into the insurance business. Having said that, of the balance sheet cash, the 250 million that I mentioned, we estimate that about 40 million of that 250 million is surplus. So there is a potential payback that I think we could realize in the form of dividend within the next 2 to 3 years. And when we put these two attributes together in terms of quality business being the first criteria for an investment case and attractively priced, I think Conduit comfortably satisfies those two attributes on many fronts. The price-earnings ratio is about 7 times. I've mentioned the discount to net asset value. I've referred to the dividend yield, although I wouldn't want to use that as a key guide here. I think that was a one-off for the near term in terms of dividend attributes. As is the case with any investment, it has specific risk. There are some attributes that I think you want to be mindful of. The first is that this is a relatively thinly traded investment, so you're not going to be able to build substantial positions in short amounts of time. You'll need to be very patient in building a position. Equally, whilst it's always easy to buy, it's very difficult to sell. So you want to be mindful of any risk on your front that might oblige you to sell. And then there is the attribute of this just being small and unknown, and that brings its own challenges, and that it requires, I think, a lot of our own homework as if we're considering this as individual investors. But put together, this may not be a widows and orphans opportunity, but we think that it is a really interesting investment prospect in very uncertain times.